Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Webb. This week, I am speaking with someone who really does know the markets. Financial historian, friend of the show, Russell Napier. He's also the founder of Edinburgh's Library of Mistakes and the author of the Solid Ground Global Macro Strategy Report. His book, Anatomy of the Bear, first published in 2006, forecast a major correction for the US stock market, and he later wrote a report called Finding the Bottom, published in the first quarter of 2009, that forecast the market had bottomed, which of course it had. Safe to say, Russell knows his stuff. And I suppose we should say, as disclosure, that I wrote the introduction to the second edition of Anatomy of the Bear. So very much a friend of the show and of mine. Russell, welcome back. Thank you for joining us again.
Merryn, thank you. Thank you for that introduction.
My pleasure. Now, listen, we have got a lot to get through. You've written a lot of really interesting things recently, and it feels like we're at turning points all over the place in markets and economies, aren't we? So can we just start by talking about something you've been writing about quite a lot recently, which is the return of national capitalism and how the election of Donald Trump accelerates the adoption of that across the Western world? Can we just set the scene by explaining that?
Absolutely. Let's start with President Macron, actually, because he articulates things. He articulates things slightly better than Donald Trump. Let's just leave that statement there. So, speaking on the 26th of April at the Sorbonne in Paris, Macron said, I'm kind of making this up. It's not going to be exactly word for word, but you'll get the gist of it. Every year, Europeans invest 300 billion euros in America. This is absurd. That's what he said. What's he going to do about it? And what he's saying here is he's talking about national savings for national investment. Our own Chancellor is saying the same thing, and the previous Chancellor, who was a Conservative, said exactly the same thing. Our national savings are not being used to fund enough national investment. Now, it's global. I mean, Donald Trump is famous for his tariffs, I suppose, but that's all aimed at 100% driving more investment in America. That's the ultimate aim of this. Tariffs will hurt the consumer, but for people, industry that is competing with foreigners, it will help them. Andrew Carnegie, for instance, became a very, very wealthy man behind the barrier of tariffs. So it's a different expression of national capitalism. But there are two bits to this. It's not just building lots of factories and building all the capacity and industrial capacity that France or America don't have. It's mobilizing the savings of the people to do so. And just the final point on that, if, like Rachel Reeves, you want more investment in the United Kingdom, you are indirectly at least mandating that they sell their overseas assets. They sell and bring it back to the United Kingdom, bring it back to France. So that in a kind of a nutshell is national capitalism, using national savings to fund national investment.
Okay, so there's two strands to this. And the first one is the impact on all the individual economies of bringing cash effectively home and forcing it into their domestic economies. And the second strand is the fact that where all that money that is now going to be, we think, dragged home will probably be dragged out of the US. Is that fair?
That's absolutely accurate. There are two countries, major countries, that are really on the line if everybody did it. So it is interesting because everybody has to do it. We're talking net here as opposed to gross. And absolutely America is first, front and foremost, both in its bond market, its treasury market, where I think 30% of that is owned by foreigners. And in that equity market, I don't have an up-to-date number, but I think it's nearly 40% of that equity market is owned by foreigners. And as over the last several decades, capital has kind of drifted away from what we used to call home bias, America's been the major beneficiary. So America number one, but France number two. And this is, I think, the untold story of this problem is that the other country that really is in trouble here is France. 54% of all French government debt is owned by foreigners. The equity market's probably 40% owned by foreigners. So France, the winners, by the way, Japan, obviously. Germany's in a relatively good position, except, of course, it shackled itself to the French through its single central bank, which is a different story, but connected to this story.
We might want to come on to that single central bank and the survival of the euro later. But let's having set the scene there by talking about Macron, let's go and talk about the US and about Trump. So how do you think this is going to unfold in the US? Because at the moment, of course, there's a very positive vibe around American GDP, around the American market. And there is, I know you and I and various other people endlessly talk about how American exceptionalism isn't as real as we think, and how valuations never stay at these levels indefinitely. There will be a reversion to the mean, et cetera, and we get ourselves in a bit of a knot about the Schiller P and that kind of thing. But nonetheless, around much of the rest of the market, there is a view that there is no point in fighting this, that there is going to be significant GDP growth in the US under Trump, and the US market will continue to surprise to the upside, or surprise us to the upside.
Yeah, well, I don't agree with that. I mean, as we've already discussed, Trump is very reliant upon foreign savings. And if you put that to any investor, they'll say, well, what's the problem with that? He's got these tremendously innovative, wonderful companies. They lead the digital era. They'll continue to attract capital forever. So for America, there's only one direction of the flow of capital, and it must be from old, weak, dilapidated Europe towards America. Well, you can buy that story, I think. There's a lot of truth to it, if you believe that private sector capital flows are always free to flow where they wish to flow to. But then in the world that we've just discussed, that's not what's going on. It may be that you and I, or at least whoever manages our pension fund, would much prefer to own Amazon than Rheinmetall of Germany, but they may not have a choice. They may wish to own the great digital companies of America rather than French government bonds, but they may not have a choice. And Trump is moving and exacerbating this war. Now, we keep calling it a trade war, but in my opinion, you can't have a trade war without a capital war. So the CAPE, as we all know, 38 times. It's only been higher than that, I think, since 1881. I think it's only been higher than that 1.5% of the time. That's fine, as long as America keeps drawing in all of that capital to fund all of that growth and sustain all of those high valuations, fair enough. But the world that Trump is unleashing, and I don't blame him entirely, everybody's up to it, is a world where that foreign capital isn't there in the same way to sustain high valuations and high growth. Now, if, like Japan, it was entirely, if you like, internally funded, that would be very different. But it's not the where America is today.
And this is inevitable, isn't it? I mean, that this is just the way that geopolitics is pushing the world, that there is a sense that we must all be more financially independent inside our countries, that the US must become more independent from China, in fact, that we all must be less reliant on China, that we all must try and rebuild our domestic manufacturing, etc. There wasn't realistically a way for things to continue in the direction they were going previously.
I think the only way is a dramatic change in the leadership of China. So we'll just leave that. I'm not forecasting it. You can't forecast it. But short of that, then we all have to do this. It is part of a secondary thing, apart from building resilience against an aggressive China, and that is inflating away our debts. And this is actually part and parcel of inflating away our debts. If we can fund a lot of this investment through bank credit, create more money, higher nominal GDP growth. So it's not just about the geopolitical strategic issue. There's climate change as well, and investing for net zero. That's another key driver of this. But it's also about getting that higher level of growth, nominal, I think, because it's very hard to spare, or very hard for government policy to change the trend rate of real growth. But if you can get nominal growth up, you might even begin to bring debt to GDP down. And these numbers are horrific. I mean, absolutely horrific. We're well above World War II levels for many countries if you look at debt composed of both the government sector and the private sector. So the inevitability in this is, short of a Chinese government change, geopolitical, but secondly, the absolute necessity now to begin to inflate away excessively high debt levels.
Okay, so if we were to try and find an upside, it is that this could be the beginning of bringing these debt levels down. And at the same time, we will, for example, in the UK, perhaps, I'm sure that lots of this capital will be misallocated by the government because that's just the way it works. But nonetheless, we may get some start on rebuilding our domestic infrastructure, which doesn't work anymore.
Yeah, I see lots of upsides, not necessarily for savers. I mean, obviously, we're on the podcast to talk about savers. We're both savers. The listeners are savers. So we're inherently interested in savers. But there is more to an economy than savers. In a world where you're inflating away debt, you're relieving pressure upon debtors. That is a large proportion of the economy, and it is a large proportion of younger people as well. So there's a redistribution of wealth underway here. There's a movement of money more towards blue-collar jobs because a lot of this stuff is going to be more manual in nature if we're going to reindustrialize is probably too broad a term, but that sort of thing. So, we did this before after World War II. Europe did it more spectacularly because it had to literally rebuild its physical capacity. And in France, for instance, this is known as the Trente Glorieuses, the 30 glorious years. Well, if you were an owner of French government bonds, you purchasing power was kind of wiped out during the glorious years. And that's what I think we all have to remember as savers. So now the question is, as a saver, how can you realign your portfolio to benefit from that realignment of wealth? Because I think the beautiful thing is we have I'm going to say a deep equity market, not in terms of liquidity for the United Kingdom, but there's a wide range of corporations one could invest in, which aren't necessarily losers in a world where we do national capitalism, inflate away debts and redistribute wealth. You are a loser in the bond market, full stop. I think that's pretty simple, pretty easy.
Yeah, I think that's the easy bit, isn't it? From everything that you've said and everything we've talked about before, you and I and several of our other guests on this podcast, if you're investing for the medium or the long term, you just want to steer clear of sovereign bond markets.
Yeah, so that's the easy bit. The more difficult bit is which equities to own, and I'm pretty sure they're not the ones that dominate the indices. So you have to be what some people would call radical, but I think there are ways to preserve the purchasing power of wealth in the sort of global, in the structural shifts that are now already underway.
Can we come back to that bit? I want to go to currencies and ask you, although I think it's relatively obvious, what happens to the dollar under this scenario?
Yeah, so there has to be a tipping point for the dollar in which it's basically compulsorily sold by its creditors. As I said, not through their own free will. When does that tipping point come? Well, I think for the United Kingdom, and this pot of money Rachel Reeves is putting together, I think it's a 25 billion, then it gets geared up. That's almost certainly already causing some sales of dollars. It's not phasing on the dollar because it's not big enough, but if the whole world gets into that, then it begins to put downward pressure on the dollar. The more difficult thing is to work out what's going up. So it's the yen. I'm going to say sterling. I've been saying sterling for a couple of years. Yeah. Everybody thought it was insane, but as I think anybody listening to this will know, sterling has just broken out against the euro. It's looking exceptionally wonderful, actually, compared to what's going on within the European Union.
And what do you think the driver behind that is? Just that the European Union countries are in such a hideous state, or is that already capital moving back into the UK?
What we can say for sure is it's capital flows, because we run a current account deficit. They run depending where you are, a bit of a surplus. So it's capital flows. Now the question is it these flighty short-term capital flows that like to come in because our interest rates are higher than European rates, or is it something more profound than that? And the frank answer is, because we've just broken out, we don't know. The market will say, it's just interest rate differentials. I suspect it's something bigger and deeper than that. I spend a lot of time talking to institutional investors, but also a little bit of time talking to wealthy families in Europe. They're terrified. They have seen what their governments are capable of in the past, and effectively it's sequestration. Mm-hmm. Now, I'm not saying the British government isn't ultimately capable of doing the same thing, and the post-war period wasn't that great. But on a relative basis, it is easy to look at the UK budget and point out how horrific it might be for growth. But compared to what is happening in France and in Germany, I think we are benefiting from wealth, assuming that we will not be as confiscatory. Now, maybe Dubai benefits a lot more. Maybe Singapore benefits spectacularly. Yes. But to some extent, I think the United Kingdom, on a relative basis, is there's so many things we don't have to worry about in the United Kingdom that are deeply ingrained in Europe's malaise, and the single currency is right plastered across all of them. So not having to deal with one monetary policy to rule them all is actually such a huge benefit that I think we're finally beginning to benefit. I mean, one more thing on the United Kingdom, and I don't want to sound like I'm just massively bullish on everything, but look, we've had lots of problems, and we've had the biggest constitutional change in the history of this country since 1688. And despite that, not collapsed, maybe not grown, but not collapsed. Mm-hmm. But the other thing we've done is massively de-geared. I mean, if you look at the private sector, household and corporates in this country, we have taken our private sector debt service ratio down from about 19% to 14%. And if you have a prolonged period of de-gearing, you're probably not going to get good investment and growth, and we certainly haven't had it. But when it's completed, when you've got relatively good levels of gearing, and to read the press, you'd think we've got horrific levels of gearing. We haven't got good gearing in the state sector. Private sector gearing's pretty good. When you get that sorted out, then you can begin to reinvest. France has gone exactly the opposite direction. I mean, exactly the opposite direction. It's the second most highly geared country on the whole planet in terms of the major countries. So why is sterling going up? Well, we have a much better private sector balance sheet. I think we'll have a state which is somewhat less confiscatory than European states. Somewhat, and that helps you to bring money in. So I don't think it's just the interest rate differential. I think there's something a bit more positive for the United Kingdom.
And does that make you generally positive on the UK stock market? And one of the things that John and I talk about endlessly is sort of the slow leaking away of the UK stock market, the disappearance of so many of our companies. John and I talked about this on our Roundup podcast this week about the number of companies that are disappearing from the market as a result of being taken private, as a result of M&A, as a result of shifting, in the case of Ashtead this week, the primary listing to the US, etc. And the fact that our government doesn't seem to have any real interest in changing that, in supporting our stock market. So looking at that and looking at what you've just said, do you still feel positive on the stock market as opposed to just on the UK in general?
Yeah, very positive on the stock market. All the things you said, maybe apart from the last one about the government, all say the same thing. They're too cheap. They're too cheap. They either want to relist because they realize they're not getting the right valuation, or they're getting taken out because they're too cheap. And as an investor, it's good to buy things that are too cheap as opposed to buy things that are too expensive. So you absolutely want to be investing in the British stock market. We had, and I think, and of course you were there, we had Anthony Bolton speaking at the Library of Mistakes. People can see that on our website, libraryofmistakes.com. One of the great questions somebody asked him is if he was beginning his career again, and his career was just UK equities initially, would he be happy just being confined to buying UK equities? And he basically kind of said he'd be delighted. He couldn't think of a better time to be confined to buying only UK equities, given the valuations he sees in the marketplace. So I thought that was a revealing statement, and one I completely agree with. And we are in a very bifurcated world of excessively highly valued equities and excessively cheap equities as well. And that gives you ground for encouragement. It's not as if everything's overvalued. There are some things that look really cheap, and UK equities are one of them.
Russell, is it a great time for active management?
Yes. And I would have said that last year, and I would have said that the year before. And we all know there has to be a tipping point when the machines, and the machines, I just don't mean the algorithms, I mean indexing. When the machines dominate the market, at some stage, the human beings are going to make a killing. And I'd say again that we have reached that point.
Given what you said about Europe and how nice it is for us not to be caught up in the single currency and possibly not to be caught up in various other European crises coming, are we about to see the benefits of Brexit, do you think?
Yeah, I mean, I think the benefits of Brexit have been profound, though not economic. And it is nice to talk about everything in economics. That's what we do here. But it was about the devolution and the decentralisation of power, which is something I happen to believe in. And the British people have had a series, over the last quarter of a century, a series of votes on the devolution of power. And almost without exception, they always vote to devolve power. Now, we have in this country the most devolved power we've ever had, because we obviously have our assemblies in Wales, Scotland and Northern Ireland, but we have these mayors who've got a relative degree of autonomy as well. Now, we probably haven't been rewarded yet for having that degree of tolerance.
I've got to say, I don't feel particularly rewarded for Scottish devolution yet. I mean, I live in hope, but not yet.
I have great faith in the people to change their minds. So let's see if they can finally, whichever assembly or whichever mayor it is, get one who's prepared to deliver for the people. Yeah. And I share your scepticism as to whether the Scottish Parliament can do that. But let's see. So here we are, massively devolved, massively de-geared in the private sector, and Europe insists on going for more and more and more and more centralisation. So everybody keeps putting their hand and saying, how come Europe's not growing? How come it's such a disaster? Well, if you constantly centralise power in Brussels and Frankfurt, what do you think's going to happen? Why do we think that's a brilliant idea? And I think you may be getting new forms of hate mail now, given that I'm being so negative about the European Union. But
probably.
But I mean, do you know that 58% of all France's spending is government spending? 58%. Now, the IMF very kindly provides us a list of that data for every country in the world. Now, the good news is for France, it's not the worst in the world at 58%. There are two countries that have got a higher level of government expenditure as a percentage of GDP, and they are Kiribati and Micronesia. So, that is not sustainable. And if you say to somebody it's not sustainable, they will reply, but it's France. That's not a good answer. If something cannot go on forever, it will end, to quote Herb Stein. So we are, whatever you think of the United Kingdom, it is somewhat flexible, it is somewhat changeable, it is devolved. And, I don't want to make it sound like everything is rosy in the United Kingdom. It isn't.
No, I mean, it's important to point out that around 45% of UK GDP is state spending.
Yeah, well, we could run through all the data. That's not abnormal. That kind of for the developed world. I think the US is at 34 or something, so that's the outlier. But for other states in the world, the UK is not an outlier.
Yeah. And China, just for fun, is about 30%, isn't it?
I don't know. We'd have to Google that.
I think it is. It's around 30, which I think is always a fun
I
stat.
think the problem with China. I think the problem in China is trying to work out what's public and private.
I think that's fair. But then that may also be the case going forward in, one of the things about national capitalism, isn't it, is that we're going to end up with capital directed by government into what we might technically call private companies or private investments. And so that 46% in the UK is in effect going to be much higher going forward. If, for example, Rachel Reeves gets what she wants and gets a large percentage of the UK pension money, because of course, why do you look to pensions? Because that's where the money is. If a lot of that money ends up being directed by the state into investment in the UK, then again, just like in China, what is public and what is private becomes very, very blurred, right?
That's why they're doing it. But the government balance sheet is stretched to a limit, maybe not the limit, but a limit. Then you have to get this off-balance sheet financing, this contingent financing, and that's what we're doing here. There's so many contingent liabilities on the government balance sheet anyway, in terms of future pensions for public workers, etc., etc. So I think with gay abandon, I think they will add a lot more, because what else is there?
Okay, let's go back to China briefly. We were talking about investing in cheap markets, why it's important in the medium to long term to hold things that you bought cheap rather than things that you bought expensive. Now, China looks cheap, but you also think it's uninvestable, right?
Yeah, so back to our cyclically adjusted PE, which I do think for the long-term holder, only for the long-term holder, is a good guide to value. And China did, just before it launched its reflation, it got to less than 10 times CAPE, and that is the traditional, hey, these things are cheap as chips level. I actually do a presentation, 21 lessons from financial history. And one of those is always buy equities below 10 times CAPE unless you don't have monetary independence, you're about to go to war, or you face confiscation of assets. Potentially China faces all three. This is the problem. Now, hopefully a Cold War and not a hot war. We are already fighting two proxy wars with China, given that they buy the oil of both Iran and Russia. And ultimately, do you have private sector property rights in China? Could you enforce your rights to own property as a shareholder against the government in a court of law? There are people I know who say the answer to that is yes. My answer to that is no. More specifically, if we do get into a Cold War with China, the assets of China will be treated the same way as Russia. And for the unfortunate portfolio managers who had Russian equities in their portfolio, they are now valued at zero. So you can roll the dice on this game, and you can hope that none of that happens, and they are cheap, and they would produce good renminbi returns. But will they produce good sterling returns or good dollar returns if you ultimately can't get your money out of that country? And that's where we are with Russia. And I really strongly believe, but hope and pray, that that's not where we end up with China.
So you have the risk of war, obviously the risk of an invasion of Taiwan at some point over the next decade, perhaps. Several people have mentioned that on the podcast over the last few months. You have that risk. You have the absolute risk to your property rights. And of course, you have uncertainty around the currency.
Yeah, and that's the key point. I mean, China headed into a debt deflation very recently, by which I mean the consumer price index was flat to falling, the producer price index was falling, the price of residential property prices was falling, the debt to GDP ratio was soaring. Why? Why did they get themselves into such a mess? Because they insisted on managing the exchange rate. Now, I'm using past tense. Most people would use present tense for managing the exchange rate. But if you look at what they're doing to reflate and what they have to do, to reflate. They ultimately aren't going to be able to sustain the stable exchange rate. But anyway, if the consensus is right and Mr. Xi is absolutely adamant that his exchange rate can never go down, then he's also surrendered a high degree of monetary independence. So those three things are now working against you. Now, I think he isn't. I think he's going to give that up, and I think they'll focus on reflating. But the longer he clings on to managing the exchange rate, then no monetary independence, likelihood of conflict, cold or hot, plus confiscatory government, 10 times cyclically adjusted PE. It's still not a buy.
Okay, so where can we expect inflation to go? Let's stick with the UK now. Most of our listeners are UK. Where can we expect inflation to go here? I mean, you've long been an inflationist, right? And that you believe that one of the main ways to get rid of debt is a period of inflation.
I have, and I strongly believe that in the longer term, but I changed my mind a few months ago in the shorter term.
That's where I was going.
That is because governments have got this wrong again. So during COVID, too much money was created. I argue created due to government action in guaranteeing government commercial bank credit, which encouraged them to expand their balance sheets and create money. We'll not go through the technicalities of that, but basically the government was complicit in the excess money creation. Then they panicked for obvious reasons. I mean, we've seen in America what the rate of inflation has done for politicians who don't take it seriously. And they handed the sort of reins back to the central bankers. And the central bankers have again got it wrong. Because we really, since the beginning of 2022, there has been virtually no growth in the supply of money across the developed world. And people will say, well, that just shows it's not important, because if there's been no growth for 2 years and the economy has continued to grow and inflation's continued to prices have continued to go up, even though the rate of inflation has come down, clearly the growth rate in broad money has no impact whatsoever. And I think I come to the exact opposite conclusion. So much money was created from 20 to 22 that there's a tank full of it there and we're running it down. But once it's exhausted, what we're putting into that tank is close to zero. And that's a recipe for much lower growth. I need to put that into context. So the current rates of growth in broad money are the lowest we've seen since the Great Depression. You know, it was really bad and sluggish from 2009 to 2019, particularly in Europe. But what we're seeing today is, I mean, not much worse than that, but marginally worse than that, which puts us right back into the 1930s. So they're riding for a fall with this monetary policy. And I can't tell you when those previous monetary balances will be run down, when we're going to watch something break in the global system, when inflation's going to fall. I don't know when that's going to happen, but we're we're nearly 3 years into a period of no growth in broad money. So we're running on empty here, and I think it's a deflation shock we get before we have to move back to something more aggressive. And the something more aggressive is going to be the government's back involved in this more aggressively. They discovered in 2020 how governments make money, not how central bankers make money. They gave it up. They got frightened. They gave it up, but they'll be back. And the way you make money is get banks to lend money, and you could get them lending to all of your lovely national capitalist projects as well. So it's coming. The synthesis is for all that and all that. It's coming yet for all that, as Scotland's national bard once said.
Okay. All right. Let's get on to the good bit. So we've set the scene. We understand what's happening, or we understand what you think is going to happen anyway. How, in your global scenario, how are we investing? We're investing in the UK stock market into the best value we can find. That bit we get. What else are we doing?
Well, we're also putting money with value managers. There's only two of them left. And what I recommend, if you can do it, is actually go and attend a value managers conference. Mm-hmm. It's really, I'm showing my Presbyterian here. It's quite good fun. You know, they talk about the stocks that, yeah, I know. Yeah. So they talk about the stocks that they like and stuff like that. And you'll meet some of them, and I do mean this. They do huddle together for warmth these days. They're not difficult to find. So go and do that. You might get some good stock ideas. I've had a few belters over the years, but you might find a fund manager that you like. So you're doing that. If we get into this position with China, lots of corporations are going to do excessively well out of that because the yoke of Chinese competition will be lifted. And if you're making anything and competing with China, and you've survived the last 30 years, then I suspect you're pretty good at it. And you're going to be exceptionally good at it when that's lifted. Yeah. And of course, we can't move on without discussing gold. So all of this is Very good for gold, and we're seeing the gold price reacting to that already. But what I'm talking about, and we haven't talked specifically about it, but in general, it's the end of an old global monetary system we're talking about here. And the last time an old monetary system broke down, gold went from $35 to 850. I cannot say that will happen again because gold's been floating and it hadn't floated up until 71. So it had a lot of, if you had a lot of inflation to price in quite quickly. But when monetary systems break down, gold price can go a long way.
Okay, now we have listeners out there who'll be listening to this and saying, geez, that is so old hat. These days, when monetary systems break down, what you need is Bitcoin, particularly when you've got a Trump government place who ostensibly at least hugely support Bitcoin, talking about adding it to reserves, a new regulatory environment, etc. Bitcoin is the place to be, not gold at all.
So obviously I disagree with that.
That's not obvious. That's not obvious. We never know who's going to go which way on Bitcoin.
Several reasons to disagree with that. The first one is I've got a long record on gold, and I have a pretty good idea what makes it goes up and what makes it comes down. It doesn't mean I can forecast that accurately, but at least I know why. And I do meet a lot of gold Bitcoin experts, and I say to them, please tell me why it sometimes halves. I know why it goes up, more buyers than sellers. And they'll tell me, well, there's more sellers than buyers when it goes down. But this is true for any asset, any good, any service on the planet. I need something a bit more if I'm going to recommend to people listening to this podcast that they should buy Bitcoin as to when you can expect it to fall and when you might want to take proactive action. And no one yet has been able to explain that to me. So that necessarily means I have to be cautious. There is no fundamental which I can point to that drives it up and drives it down beyond mere assertion that everybody will always want to buy it. Number one. Number two, government policy. Trump is keen on crypto. There are three types of crypto. There are central bank digital currencies, which I think we won't talk about. I don't think they will take off. But then the other two are stable coins and private sector crypto, which is Bitcoin. In terms of the national capitalism financial repression agenda, one of those is incredibly helpful and one of those is incredibly dangerous. And the one that's incredibly dangerous is private sector crypto because it allows people to escape a financial repression. And that's why they like it. And if you hear people talk about it, they'll tell you that's exactly why they hold it. Now, a world where a government allows that portal away from the repression they're trying to bring in is a strange world, and I don't think one that's ultimately sustainable. So I don't think that's on the agenda today or tomorrow. But if, let's say, government bond yields in America were spiking higher and it turns out that everybody was getting their money out of the country via Bitcoin, I think you'd see a change quite quickly. Stablecoin, however, is really very, very helpful for governments and particularly for the United States of America, because ultimately it's largely these days backed by holdings of US T-bills. And if the world can come to hold Tether or any other stablecoin and believe that it's effectively a dollar, then it funnels money into President Trump's currency and it funnels it into his government debt market. And that's what he's going to like. So I think as time goes on, we might see that the Trump administration is really very keen on properly regulated stablecoin, which is really little more than a money market fund attached to the blockchain, but not so keen on that portal, which is a private sector currency, which allows people to avoid national capitalism. So let's see where we get to, but those are the fundamental reasons. And no one can tell me what Bitcoin is for. I mean, everyone now, they used to say it was a currency. Everybody's convinced it's not a currency anymore. So I've long described it as a very, very liquid, large, efficient baseball card. And it is possible to make money out of baseball cards, but you need to understand the baseball card market. But it doesn't have a use beyond being a speculative asset for the avoidance of the government. And that's why people like it. And if you think it can continue to be an asset in which you can constantly avoid the government, whether you are doing that legitimately or as a criminal, then it has a future.
Okay. Well, I'm just bracing myself for the hate mail. Actually, the Twitter campaign against not just me this time, but you as well. So at least I'll have company. Thank you for that. The one thing we haven't talked about that I would like to talk about briefly is Japan. How is Japan affected here?
Yeah, Japan's fascinating now, I think, because just on that short-term issue, it also hasn't got much growth in broad money. And they've spent 30 years not working this out. I mean, 30 years of them sitting around going, what's going on here? How come our debt's always going up relative to our GDP? Could it be, perhaps, that you don't create enough money to have a higher level of nominal GDP? Could that possibly be what's going on here? So it has to be said that, like everybody else, they still haven't worked that out, but they're going to have to work it out. So Japan's going to face, I think, the same short-term problems as the rest of us. But now, to their advantage, they have this huge balance of overseas assets. So they have a gross number, but they also have a net balance. And they can begin to repatriate that. They can begin to continue to hold down their government bond yields. And at some stage, someone's going to work out, if banks lend money, they create money, and nominal GDP goes up. So equities there are more reasonably valued. And certainly the second tier equities look still use the word cheap. So there are still opportunities in Japan, but we may be in for one of these shocks, these deflation shocks, which are just coming across the developed world based on where broad money growth is. So I don't hesitate to buy Japanese equities for the long run, but I think maybe it's just the time to be a little bit more cautious because of the trends in money supply growth.
Okay, brilliant, really useful. Thank you. Right, I think we have pretty much covered everything that I wanted to talk about, although I know there's so much more. But I wanted to ask you one last question, and this is a Christmas-related question. If there was one book that you felt all our listeners should be asking for Christmas, one that isn't written by either you or me, which I know narrows it down quite a lot, is there one that you would say really is a must-read for someone who wanted to understand some of the things that we've been talking about, or someone who just wanted to be a better investor?
Yeah, there is one book I always recommend. It's out of print, so that's not particularly helpful, but let me start with that one. It's and I'm sure you've read it. It's called Triumph of the Optimists by Dimson, Marsh and Staunton. And it will sound like the world's most boring book, but it's the history of the return of various assets over very long-term holding periods. And the reason it's so essential to read it is to calibrate yourself. And I think particularly if you're not a finance professional, it's easy to become uncalibrated. And if you ask, certainly I remember this back in the dot-com bubble, if you ask people what they thought the average long-term return from equities was in a bull market, they came up with 25% per annum. Completely, totally, utterly uncalibrated to realize that the answer is about 6.5 real terms. But you can look at all the asset classes. So that will calibrate you. And it also helps inoculate you from dodgy salespeople who promise you 25% to infinity and beyond. So there's that one, and I would recommend that one if you can get a copy. And I'd recommend to the publisher that they republish it and get it back into the system, and potentially even update it because it only runs to the year 2000.
Okay, well, maybe we can create enough demand that it does get reissued.
It'd be wonderful if you could do that. You've got power beyond your knowledge. I think you're going to do it.
Okay, Russell, thank you so much for joining us today. We really appreciate it. That was fascinating.
Great, thank you.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm Merryn SW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Sam Asadi. Production support and sound design by Moses Andam. Special thanks, of course, to Russell Napier. Want to listen to episodes of Merryn Talks Money ad-free? Become a Bloomberg.com subscriber today. Check out our special intro offer right now at bloomberg.com/podcast offer, or click the link in the show notes. You'll also unlock deep reporting, data, and analysis from reporters around the world. If you're already a Bloomberg.com subscriber, connect your account within Apple Podcasts to listen to this episode ad-free.